Alright, continuing with the Chapter 8 presentation on accounts and notes receivable. We're on slide 27 on valuing accounts receivable. And here we have the illustration, I believe, shown in the text, on page 402. This is the entry to record the estimated uncollectible amount of accounts receivable for this company. So the credit manager estimated that $12,000 of the credit sales would prove to be uncollectible. So therefore, at the period end, they make an adjusting entry for this estimated amount of uncollectibles by debiting bad debts expense and crediting allowance for doubtful accounts for that $12,000. Slide 28. And here is how accounts receivable and the allowance account are displayed in the balance sheet, with $188,000 being the net realizable value of the accounts receivable as shown, being the difference between the accounts receivable balance of $200,000 less the allowance for doubtful accounts of $12,000. On slide 29, here is an actual write-off, as we discussed previously, with the debit to the allowance account, reducing the estimated uncollectibles, since 500 of the estimate has basically now come true, and the associated credit or reduction to the accounts receivable account. On slide 30, so now if the debtor whose balance was written off subsequently comes up with the payment, we need to reverse what was done before with the write-off. That is, the accounts receivable balance needs to be reestablished, and the allowance account needs to be credited to wipe out the write-off amount. So that's the first step in the entries that are needed for a follow-up collection from an unexpected source, that is a customer that we already had written off their balance. So first thing, we reestablish their balance due. Secondly, then we recognize the actual collection by debiting cash and then going ahead and crediting back the account receivable for the $500 amount. On slide 31, a percentage of receivables basis for computing expected uncollectibles is based on management's judgment, which is probably based on some history. And one of the ways that is typically used to help management make this determination is by preparing an aging schedule of the accounts receivable. So in this instance, the customer balances are classified by the length of time they have been unpaid, as stated here on slide 32. By aging the accounts receivable, the company may get a better idea of how to estimate the uncollectible amount, because the older the balance, the less chance historically of collecting it. Note how the percentages of uncollectibles estimated increases as the age of the receivables increases, which recognizes that the older accounts may not be collected as successfully as the newer ones. On slide 33, this example is shown on page 405 of the text. This is an adjusting entry made at the end of the period, as we previously discussed, but this one has to do with adjusting the allowance account upward based on the analysis of uncollectibles from the accounts receivable aging schedule. And this is more typical of what will go on in the real world, is that the company will need to make an adjustment to an existing balance of allowance for doubtful accounts to pump it up to what they think it's going to be, or it should be overall, based on the current accounts receivable balance. On slide 34, this example is shown on page 406 of the text. For whatever reason, they did not increase the allowance account in 2009, even though the receivables balance increased. However, sales returns are also included in the allowances account in this case. On this ethics insight shown on slide 35 here, see the additional discussion of this case and question on page 443 of the text. Significant reductions in the allowance account should be explained in the disclosure notes to the financial statements, because That is obviously a potential red flag when an adjustment of that nature is made. On slide 36, we go into notes receivable. So this chart explains the most common uses for notes receivable. The note is a more formal arrangement than the account receivable, since it usually involves a larger dollar amount and or time period for repayment. And as the slide says, a promissory note is a written promise to pay a specified amount of money on demand or at a definite time. And there's usually interest involved in that because of the time value of money. On slide 37, note the relationships and the terms of the note, including a due date of 2 months after the date of the note and an annual interest rate of 8%. In this chapter, we're looking primarily at the payee side of the transaction, in which the note is a receivable amount. And going to slide 38, note that the calculation for determining the amount of interest that will be due along with the face value of the note. What this formula does is adjust the interest based on an annual rate to the amount that is actually accrued and payable over the life of the note, which is often less than a year. And on slide 39, note how 360 days is used as a convention for a year in these calculations of interest so that they'll come out more evenly. On slide 40, this example is shown on page 409. Note that since this is the beginning of the period for the note, there is no recognition of interest at this time because none has yet to accrue. So we're simply debiting the note at its face value and crediting accounts receivable because this short-term account receivable has now become formalized as a note receivable. On slide 41, for notes receivable, there may be a need to recognize that some percentage of notes will not be collectible, just as with accounts receivable. Therefore, an estimate of bad debts expense and associated allowance for doubtful accounts may come into play with notes receivable as well. On slide 42, we have another vignette here, and it sounds like from the discussion on page 444 that the issue of fair value for instruments like notes receivable is still pretty much up in the air. That's one reason why we're not spending a lot of time on IFRS in this course. Going to slide 43, this slide shows 3 ways that a note receivable may be credited off in the accounts. The first, holding the note until maturity, is the most likely scenario, but the other 2 are possibilities as well. Default or the holder speeding up conversion to cash by selling the note. And on slide 44, if a dishonored note is not paid in full at maturity and therefore is no longer negotiable, what does this mean regarding recourse for the payee? Well, for starters, the payee, or that is the seller, still has a valid claim on the assets of the maker, that is the buyer. The question is how the seller wants to handle this accounting-wise. One option that the text does not specifically mention is writing off the note receivable, but debiting the note balance to accounts receivable, where it becomes an unsecured loan to the buyer. The interest income accrued during the note's period will be recognized as well, so the accounts receivable debit is the sum of the note's face value plus accrued interest. The other option is, of course, to simply write off the note by debiting bad debts expense or the allowance for doubtful accounts if it is used for notes, and crediting the notes receivable for its face amount. On slide 45, this example is shown on pages 410 and 411. In the above entry, the full interest revenue amount is recognized and credited at this point because it's the maturity date of the note and it was paid. Note how the interest receivable was computed for September 30th in the text, since the company prepared financial statements for that period end. To do that, they simply needed to use the number of days the interest had accrued up to that date, divided by either 360 or 12 months. In the text, 4/12 was used. On the next slide, we'll see that the September 30th entry, and then how that impacts the note maturity date entry as well. So on slide 46, here's the accrual entry at September 30th we just discussed, which recognizes the interest revenue that has accrued on this note up to that time. So we have a debit to interest receivable and a credit to interest revenue of that $300 computed as shown. And as we go to slide 47, notice how that in-between entry on September 30th, shown on the previous slide, affected the accounting at the maturity date. Now, instead of crediting the entire $375 to interest revenue, we credit only the remaining piece that was not already credited on September 30th. In addition, the interest receivable amount of $300 accrued on September 30th is now written off by a credit entry to that account, because it's been recognized, it's no longer, or it's been collected, it's no longer receivable. On slide 48, note in this presentation how accounts and notes receivable are grouped together in a single line item that may be referred to as trade receivables, as indicated in the allowance for doubtful trade receivables entry. This is important for quiz and exam purposes, to recognize that this term trade receivables can be used for the sum of accounts and notes receivable, but not for these quote-unquote other receivables that we'll get into, I think, again a little bit later, that are the loans to officers and some of the other extraneous things that don't involve sales revenue in any way. On slide 49, note the 5 steps of managing accounts receivable that are shown on this slide for potential quiz and exam purposes. So we're talking about figuring out to whom we extend credit to, establishing a typical payment period, whether it be 15 days, 30 days, etc. We need to monitor collections, and that includes some follow-up activity for customers that are not paying on time. We need to evaluate the liquidity of the receivables. One of the ways of doing that by preparation of that aging schedule. And we need to look at possibly accelerating cash receipts from receivables when necessary by doing things like perhaps selling them, which we'll get into in a minute here. But with that, I think I will stop this part of the presentation and save the rest for part 3.